Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're fortunate to have with us Joe Cavatoni, market strategist at the World Gold Council, as well as principal executive of their funds business. During his 30-year-plus career, Joe has created global investment strategies across a wide range of asset classes, from ETFs to digital assets to derivatives. Prior to joining the World Gold Council, Joe was a managing director at BlackRock, responsible for iShares capital markets in the Americas, as well as had senior positions at UBS and Merrill Lynch. Welcome to the podcast, Joe, and thanks for joining us today.
Thanks for having me, Gary. It's great to be here.
Joe, it's been quite a year, continues to be quite a year for gold. Gold is clearly a unique and storied asset, stretching back thousands of years. And given its continued strength this year, are there still aspects you think of gold that are sort of misunderstood by investors or not fully appreciated?
You know, Gary, it's a great question and a great place for us to start the discussion. So as the World Gold Council focuses on just that, education on gold, we try and make sure every investor understands a few key principles about the asset. First, that it does provide long-term returns, and those are in line with what you should be expecting for long-term returns on global equities. Second, it's unique amongst commodities and probably the most misunderstood element of the commodity market and gold itself, that it has a very unique economic condition that grows demand when wealth is created, but also grows demand when risk is permeating in the markets. And that gives it a very unique diversification characteristic when you add it to a diversified portfolio. And then lastly, it's very liquid. A lot of people understand gold's a big market, understand that there are a lot of ways of accessing the market, but it is a very, very liquid market. And we want to make sure people understand that that liquidity is there for you when you need it most. And it'll help you out when you add it into a diversified portfolio.
Can you also speak to the extent possible, do you have a sense of or forecast for price direction or just general, direction for gold? And what do you see as potential catalysts, as well as, are there potential speed bumps along the way to get to a continued appreciation?
Yeah, this is a really interesting question to ask us even today, because right now what we're seeing in terms of the characteristics of gold is gold being accumulated, performance being very strong. Specific to your question around price forecasts, we leave that to the commodity analysts. Now, you can look at the biggest names in the market, whether it's Goldman or JP Morgan, Citibank, UBS. They've all got varying levels of outlooks that range anywhere from 3,600 up to 4,000. And that's a number that's being talked about a lot more. But what we want to make sure everybody understands is the demand profile for gold is what we track and trace and give everybody transparency on. So investments, central banks buying, jewelry consumption, and also a little bit of technology and industry use of gold. And what those four dimensions of demand are telling us, the case remains strong. Now, the catalysts that you've asked about, probably one of the biggest catalysts that'll move the price even further than it's moved to date right now, which is nearly 40% up on the year, is what the Fed's going to do short term on interest rates. A move on the interest rate cycle will bring more demand back to gold. It'll make it a lot more appealing to carry it on the balance sheet for clients, as well as increasing that environment for people looking at how do you diversify away from less yielding assets that may have been more attractive to you, cash balances or bonds, and those correlations that play out amongst those different assets. So right now we're going to see gold flatline a bit, and with the catalyst of the Fed's move, likely going to be bringing back more momentum in the asset.
Currently, what do you see as sort of the sentiment or tone in conversations with, say, different asset owners like hedge funds, mutual funds? I mean, what are you hearing? Where are they?
Yeah, so there's a wide range of different views and a lot of questions being asked. You ask about hedge funds. Most hedge funds get it. Most hedge funds are understanding the asset, but most hedge funds look at it more tactically than the increasing level of conversations we're having with real money accounts around strategic allocations. Now, those conversations are at varying levels. Some may have already taken a view on gold or looked at diversification against inflation risks or correlation risks, but those conversations are happening a lot more today. When I talk about real money accounts, I'm talking about asset managers, I'm talking about pensions, endowments, foundations, private wealth, high net worth individuals. And these conversations are happening globally because what's really playing out for gold needs to be well understood. It's a global dynamic. Eastern investors, Western investors, all at the table buying. And not to overlook it again, the significant conversation that's taking place at central banks as they diversify their reserve portfolio. So for us, this is a big market where lots of questions are being asked and more people are making bigger allocations, ranging from that 2 to 5% level versus what we've seen in the past, which has been lower 1%, maybe even 1.5%.
Right, which you touched on an interesting point there. Asset allocation. You just laid out, how some investors are looking at that. Do you think that's appropriate? Should that be higher? What's your perspective on portfolio asset allocation for gold?
100% people should be taking the time to do the homework. Every portfolio is unique and different. Everyone should basically do the homework. We can help you. Every one of those firms that I've just mentioned previously can help you, and everyone should look at what an allocation could look to do for your portfolio. Now, we use a sample portfolio on our website and give you 2.5%, 5%, 7.5%, and 10% allocations and show you risk-adjusted returns are improved across the board when gold's added to those portfolios or to that portfolio. So it depends on what your objectives are. It depends on what your time horizon is. But you shouldn't be afraid of the price being high right now, and you should be looking at your portfolio regularly to say, what do I need as a diversifier that protects me on drawdowns, that gives me steady returns over the long haul, and is liquid when I need it to be? And that's what gold can do for you. So do the homework.
What data points, what leading indicators should investors who maybe haven't dipped their toe in yet, what should be part of their homework assignment in this sector?
What are you thinking about in terms of the risk assets that you hold, and how concerned are you when it comes to those risk assets having a gap down? That's first on the list. Second, what I'd say is you need to understand in those moments of stress, what happens to liquidity. That's a shining point for the gold market. It's liquid and it holds its price when you need it. And then lastly, get away from being fixated on what an asset is and how it helps your portfolio. That's where people need to understand this. We've had long-standing conversations with some of the biggest pensions in the world about how do I hedge inflation? What's the best diversifier for my portfolio? Not whether or not I can buy a commodity or not. Ignore that. Find the home for gold in your portfolio based on a need. And the need right now is diversification. And that's what's key right now.
And does that change at all? Say if someone has a 3 to 5 year time horizon, how should they look at that, for their investment framework?
For us, we would advocate to think longer term and higher levels of allocation. That would be what we talk to people about. You can have a component of your gold allocation that tactically gets dialed up and dialed down. But if you're looking at those characteristics longer term, you should be looking at gold today. You should be looking at a larger percentage. We've talked with a number of different fund managers, and they're telling us that 2, 3, 4% is a minimum for the gold investment, because below those levels, it doesn't have any impact. So get comfortable, confident with it. There are easy ways to access it, which I'm sure we'll talk about, and actually put that sticky, long strategic hold in your portfolio, hang on to it, and dial it up and dial it down using instruments that can get you access.
Can we shift now into a discussion of the demand side of the equation, which has multiple potential asset owners? One of them is global central banks. They continue to diversify reserves into gold. How much more runway does this trend have? And what signal does that send to institutional investors to take from this trend?
So the big signal it's sending to the institutional investors right now is questions over what and how the U.S. dollar and U.S. dollar-based assets that are still a very large component of these emerging market, developing market central banks, it's a big component of their reserve portfolio. But it's sending a message that says, am I certain it's going to achieve what I want it to achieve? Is my portfolio of reserves? Or should I be looking at something that does have the right characteristics? So it's a 15-year trend now where central banks globally have been net buyers across the board. It's a diverse universe of central banks that are buying, ranging from China to Poland, Singapore, the Philippines. We have all this information on our website. And actually, interestingly enough, we do an annual survey that we would encourage people to take a look at. And what they signal in that survey is for the next 5 years, reliance on the dollar and the euro will both be lower for central banks as a component of their reserves. They're looking for something different. They're looking for something they could use globally for trade, for portfolio protection, but also to stabilize onshore if they need it. And we have good examples on our website where some central banks have stepped in and stabilized their own currencies by buying it back locally and selling gold into the community. So it's a big market, and it's had record flows for the last 3 years, or near record flows. Will probably slow a little bit over 2025, but rest assured, the information that we're seeing and hearing from the central banks that we talk with is that they are firm buyers. They like prices at around 3,300 more than they do at 3,600, but they are going to be at the table for some time.
Right. So it sounds like the shift you may be pointing to here is secular in nature. Is that the case?
I agree with that 100%. And actually, again, I encourage the listeners to do a little bit of research on this because it's a fun topic to unpack. You know, you're hearing that the gold balances held by global central banks is larger than the euro. There was a suggestion in a tweet that maybe more gold's held than treasuries. We don't know if we necessarily agree with that point. What we do know is how much people are holding in gold, and all of that information is on our website. In addition, that survey is just chock full of information that people can use to gauge what that one channel of demand, central banks, is going to continue to do when it comes to the gold market. It's not about a silver trade. It's not about a commodity trade. It's about gold.
Right, right. What about emerging markets? You touched on that, China, India. How do you see the demand there, and how could that impact supply and pricing for gold?
You know, I love this question because most people probably don't realize, but about 70% of all demand for gold is consumed in the emerging markets. And it's a huge component of what drives the price for gold. Whether it's at a central bank or an investor or a family office, it's big and it's important. Most of it trades in the OTC market, over the counter. So we often fixate on ETFs here in the US, but really for us, we kind of keep a good watch on everything that's happening across the board, including the OTC market. Now, China, India, and Japan are markets that really stand out, particularly when it comes to the demand for gold in the form of ETF. 2024, they all had record flows in our ETF markets locally. China and India slowed down on the retail side with jewelry and small bar and coin. And that actually is picking up in the bar and coin side. But because these high prices tend to often impact consumers' behavior when it comes to things like jewelry, we're still seeing that slow down. But again, I want to amplify the message that investment in that part of the world, Asian investors drove the market in 2024. Half of 2025 was driven by the Asian market, slowing a little bit now. But these are big capital markets with homegrown challenges like China's real estate market, its equity market, its bond market, all onshore, and allocations to gold are significant in these places. So we watch it globally, and it could be a big driver for us, or it could actually give us a little bit of that headwind that you had mentioned earlier in our conversation, like what could slow us down a little bit. Maybe a slowdown in India, China, and Japan. Could be a little bit of a curtailing for the speed with which the gold price continues to accelerate.
And you've touched on emerging markets, central banks, institutional portfolios. Should we think about it in terms of a priority order as far as, what's going to be a key factor here, or they're sort of all equal weighted in your minds?
So that's a great question. And I'd say keep your thinking around what are investors doing? What are central banks doing? How does this look from a consumer behavior? And then let's talk about that 10% of industrial and electronic and technical use. It's important, but it's not driving the price. So those three power alleys that I've just talked to, investors, central banks, and consumers, if you understand the dynamic of how they're behaving in light of economic conditions locally and globally, fiscal challenges locally and globally, then you'll start to understand why they're buying more or selling more, or actually picking up the pace of consumption or slowing it down.
Let's shift into products. The product market is evolving. It's dynamic, significant growth in gold ETFs. What do you see as the opportunities and challenges for gold ETFs in today's competitive landscape?
So I think to just make sure everybody understands, the gold market is a physical market, but there are also financial products. And I want to set the record straight. Anybody that refers to an exchange-traded fund as a paper version of gold is putting a label on it that is not only unnecessary, but just misleading and wrong. So when you think about investing in gold, those are your two choices. I can either buy the physical asset or I can buy a financial instrument. The regulated exchange traded fund market, particularly in the US, is over 20 years old and actually without issue, challenge, or problem, and actually works quite effectively to give you the price performance packaged in a regulated security of gold, and it's actually perfectly acceptable to use. It's over 420 billion in terms of global AUM at this point, and actually it's a perfectly acceptable way to get access to gold. I think people just need to move away from any questions of whether or not the gold is there. Being the principal executive officer for two products that are in the market, rest assured, the gold's there. It's audited. It's actually weighed and tested every year, twice a year. It's sampled. And the process for how gold ETFs accumulate and distribute out gold when it comes to creations and redemptions, all working effectively on a mechanical basis. I think the biggest question that we need to find is how those exchange traded funds, and answer the question we need to answer, is how those exchange traded funds can be used by more audiences. Like, can we get them into 401ks? Can we get them into mutual funds without any kind of punitive tax treatment? Those are things that we're working on because we want to open up all audiences to own gold. Now, I don't want to ignore the physical side, but it's a different analysis when you go through that because you have to understand holding and custody and the cost of owning physical gold and where to go and how to get that done in terms of trading it. It's not hard. It just takes a bit of different work, more from your back office side, your custodian side, understanding those mechanics versus buying an exchange traded fund.
And is there some time frame you have for that that we should think about as being, the sort of the roadway to get there?
So in terms of mutual funds, 40 Act funds, we've actually got a piece of legislation that's been drafted. It's looking now for a tax bill to find a home in, but that's been drafted. That's actually open. And in this administration, we're encouraged by ideas of opening up and actually getting more access to assets like gold. So we're really excited on the Precious Metals Parity Act that it could potentially get picked up in the next 12 to 18 months.
And taking it a step further, the relationship between gold and digital assets like Bitcoin, competitors, complements, or it's just something else?
So when we think about Bitcoin, this is a question we get a lot. And actually, we're actually not worried. And actually, more interesting than that, we look at it as an interesting asset that actually benefits when you hold it by adding gold to that allocation. Because what comes with Bitcoin is risk and actually characteristics of tech stocks and actual, assets that provide you return, but at a risk. So when we think about returns, diversification benefits, liquidity, and so forth, those are all easily understood in the gold market, challenging in the Bitcoin space. So it's not replacing us. It's not actually, taking asset flows away from gold any more than it is from anything else. So it's basically existing as an interesting experiment that pretty much represents the tech future, but not necessarily the safe haven nature that you get with a sound asset like gold.
From an innovation perspective, on the horizon, what kind of things are you most excited about in the gold sector, whether it's investment side, mining side, and in particular, what impact could AI potentially have on the gold sector?
So there's two things that I want to highlight that are really interesting and exciting bodies of work that the World Gold Council is involved in. The first, and you just asked about gold and Bitcoin and digital gold. So there's a process in motion for digitizing gold, dematerializing it, keeping its physical nature in place, but also giving people new venues and new ways of accessing it. Now, this is going to take some time to develop, but we're on this journey as an organization with organizations like the London Bullion Market Association and big bullion banks like JP Morgan, HSBC, and this journey's in flight. So what we're doing is we're tracking and tracing information around existing gold bars that are coming into the ecosystem under our Gold Bar Integrity Program, which gives us a better control and understanding of that trusted network of large bars. That and work we're doing with market participants to beta test a world around pooled gold interests will give us a much more robust platform for digitizing gold in the future. So there's a lot that's going to develop over the next 12 months in this space. I'd say watch it, because what it is not just tokenizing gold, which is something that's happened already, But those products don't take off because they're not solving a problem. What we're looking at doing is enhancing the gold market, making it better, easier to access, more participation, and actually digitizing that in a more new and innovative way. So keep an eye on that. The second piece that's actually very interesting on the mining side is we're tackling down some challenges that come with artisanal and small-scale gold mining. This is about 20% of the mining production on an annual basis, looking at World Bank estimates.
Lastly, you have extensive experience. You're in the marketplace every day. What's the biggest untold story about gold for investment professionals that they should be paying attention to right now that they may not be focused on?
There's a place for it in your portfolio, and it's easier to achieve ownership of gold than ever before. Lose the old mindset on it, bring it into the norm, and actually take a look. If you need help, we can help. There are many organizations that can do the same, but you need to evolve your thinking about the asset because it's an asset for here and now and for the future.
That's great, Joe. Thank you for sharing your perspective and insights with us today. This has been the CFA Society New York Compound Insights Podcast. I'm Gary Farber. Thanks for listening, and we'll see you again soon.